Little last-minute procrastination on the slides. I'm sure you college students know all about that. So my talk is about making the claim that Bitcoin is the only blockchain that matters. That blockchain is a very, very purpose-built set of technologies that solve one very specific problem, the creation of digital cash. And that this problem is very important. Money underlies a lot of our civilization, a lot of our activities, and the money that we use now can be improved, as the last speaker did a great job of explaining. And so I'm going to try to counter the idea that blockchains are sort of a magic sauce, a secret sauce that you can sprinkle over whatever problem you have, and that problem will go away. So hopefully that's the idea that that's the idea I'm trying to fight with this talk. So a little bit about me. I'm a Bitcoin developer. I've built a couple wallets. I built a hardware wallet, BitBoy, if you want to Google that. It's like a $100 thing that can store Bitcoin private keys, and you can assemble it with off-the-shelf computer parts. It's pretty interesting. And I work a lot with wallets, and then I teach a Bitcoin programming class called BITL Bootcamp. So if you want to learn how to work with the Bitcoin protocol as a programmer, how to program money, I invite you to take my class, talk to me afterwards. So that's my background. So let's start with what is a blockchain. So I'm going to sort of give a very basic explanation here and not go into too much detail. So the first thing is that a blockchain is a database. And it's a specific type of database that adversarial parties can share. Usually a database is not shareable by people who are adversaries, who are fighting, who are attacking each other, right? Usually sharing a database requires cooperation. You agree not to delete the rows in the database that your buddy added and not to screw with each other. It requires a lot of cooperation. And Bitcoin is different in this way. You can have a database which parties that are at odds can share. Database updates are called transactions. This is the same in every database. And transactions are applied in batches, in groups of transactions. And these are called blocks, if you've ever heard of a block. A blockchain is a chain of every one of these batched updates of the state of the database. One thing that blockchains do is that they make block production, the application of these state updates, these updates to the database, they make it very expensive. And the reason they do this is that they want to make cheating expensive. So in order to nominate one of these updates to the database, you have to assume a cost. And if you cheat, people will catch you, and you lose all that money that you invested in producing this update, right? And so in order to catch cheaters, every participant in the network has to download and validate every block. This is a big responsibility. It's a lot of work. It's very slow. Everyone has to know the entire history of the blockchain, which is a big constraint. And to reward compliance, you give a reward to people who produce valid blocks. And the reward has to exist inside the blockchain. You can't say, okay, JP Morgan Chase, give this guy $50. Because this is an adversarial setting, you have to assume that someone's going to attack JP Morgan, try to convince them to not make this payout. So it has to have like a token inside the data, inside the blockchain with which it can pay. And lastly, there's this idea of forking. So you have this like blockchain, right? Block, block, block. And let's say at this point, all of a sudden, a new set of rules for how the blockchain works is proposed. You can do that, and you can sort of create a new version of the blockchain, and they sort of go in parallel, and it's a popularity contest at that point. And this is how blockchains evolve. You can have forks where the rules change, and every participant of their own free will can opt into the version of the rules that they think is correct. And the idea is that since there's a financial reward and since the data is very important, everyone will converge on one blockchain instead of like 1,000 different ones. Okay, so how does it work? Blockchains are a combination of like 3 totally unrelated technologies. Nobody before Satoshi ever thought of combining these 3 technologies, and this is important. It's like every great invention, somebody who masters the problem space has an insight to do things differently. And usually this insight does not apply anywhere else. It just applies to this problem. And my claim is that that's how it works with blockchains and Bitcoin. So these three technologies, digital signatures, peer-to-peer networks, and hash functions. Hash functions are all proofs of work. Proof of work is probably the better word there. So let's go briefly through each one of these. So the first one we have is a digital signature. So the idea here is that you have sort of a username and password. The red key is like a password. This is Alice's password. The green key is like Alice's username. If Alice wants to sign a message, in Bitcoin's context, this message is, hey, I want to send someone some money, right? I want to update the database. That's what the message would be. Here for, I stole this off Wikipedia. In Wikipedia, it's Hello Bob, right? So Alice is able to combine her private key with the message in an operation called a signature and produce this digital signature, Hello Bob, it has sort of like, it's the middle one, it has some little digits associated with it. And she's able to pass that over to Bob. And Bob is able to combine that with the message that was originally signed and Alice's public key, her username, and verify that Alice actually did this. Alice actually authorized this message. And in this process, Alice did not have to give up her password, her private key. And so this is how Bitcoin's transactions work. When you want to send someone Bitcoin, you prepare a message that says, hey, I want to give 10 Bitcoin to some key. Bitcoin doesn't know about names. It's all public keys in Bitcoin. There's no real world human. Bitcoin has no clue about humans. I want to give some coins to some key. You sign it, you put it out to the network, and everyone participating has to verify that it's valid, right? So another technology is a peer-to-peer network. In a normal network, you have a server in the middle, right? That's this like tower-looking thing, and then everyone connects to that server. It's very efficient because that server can be really fast, and it's like purpose-built to do one thing. But the problem is, in sort of an adversarial setting, people are going to attack that, right? The government, if they don't like this, will try to shut that down. And so it's a weak spot. So you kind of saw this with like file sharing applications, right? If there's just one file sharing server, that's going to get shut down. But if you move to a peer-to-peer architecture where everyone connects to everyone else and there's no privileged participant in the network, it becomes much harder to shut down. You have to shut down every single computer in the network because everyone just connects to some neighbors and they get information from their neighbors, and it's very resilient against attacks. And in this situation for Bitcoins, for blockchains, or for Bitcoin and blockchains, in an adversarial setting, this is very useful. There's no obvious place to mount an attack. This slide isn't the best. These are hash functions, right? So let me sort of explain this. There's two sort of sections here. This ellipsis sort of separates them, right? There are these hashes above. There's 11 of them. They're just like these blobs of data. And then there is this bottom one. This is what they usually look like. Here's the bottom one. This one's from Bitcoin. This is what they usually look like. Can you notice a difference between these two? Bunch of zeros on the bottom, right? So the way Bitcoin's proof of work works is like every single digit when you, so these hashes up here are the first 11 numbers, 1 through 11, right? And a hash function just creates a unique digital fingerprint of that data, right? And so every digit has like a 1 in 16 chance of being anything like a 0, right? And so to get 1 0, it's like 1 in 16. 2 zeros, it's like 16 squared. To get 18 zeros, it's 16 to the 18th power. And so each one of these computations has a cost, and to get that many leading zeros is a ton of work. It would take my laptop like eons to do that. And that's how the Bitcoin network verifies that the block producers are actually assuming a cost, and that if they cheat, they're going to lose money and go away. So in summary, there's these like 3 very unrelated things that are combined to make a blockchain, and the blockchain is very specific. It's trying to make digital cash, and anything that doesn't have these, like let's say you don't have a peer-to-peer network, that's not really a blockchain anymore. It's a really crappy database that has like a single server and isn't good at anything and is completely useless. Let's say you don't have this proof of work hashing. You do some sort of like a voting system. It's not terribly resilient. It's not like this objective system that Bitcoin has. And yeah. So let's discuss when blockchains don't help. So the big thing is blockchains don't help when real-world data is involved. So real-world data is like who owns that house, right? Who owns that stock? Where are the peaches on their way from Georgia to Milwaukee, right? The big problem is the Oracle problem, is like, how do you get this information into the blockchain? You have to trust somebody. Where are the peaches on the way from Georgia to Milwaukee? Like, there has to be an actual human who makes that call and uploads it into the blockchain. That's the person you attack. That's the person you corrupt. You're trusting them to do their job appropriately, and in this adversarial setting, that's not a good bet. Enforcement is another problem. Let's assume you find some magical, uncorruptible oracle that can get the state of the world into your blockchain. Why would the external world respect what your blockchain says as its database sort of moves forward, right? If you're storing real estate on the blockchain and it says, like, I own the state of Delaware, right? That's what the blockchain says. Do you think the state of Delaware cares at all about that? No, and the blockchain has no way to enforce this claim in the real world. It can only enforce this claim if the asset in question is native to the blockchain itself, because then it controls everything. If it's a real world thing, it's just like it's a spreadsheet on my computer. Like, who cares? It's not really that useful. Another time you don't want to use a blockchain is if any other traditional database feature matters. Speed, scalability, cost. Blockchains sacrifice all that to get the sort of the censorship-resistant properties that make it useful for money. So here's a couple things. We sort of alluded to these. The supply chains suffer from this Oracle problem. How do you know whether the peaches went bad or not? How do you know they're good? Where are the peaches? These are just human calls. Like, it doesn't really help to put this in a magical blockchain, because blockchains are useful because you can remove, like, all trust. Well, if you have to trust somebody to input data, you're not trustless anymore. You're trusting humans. Real estate and stocks struggle from enforcement, right? It doesn't matter who owns. If the blockchain says that I own 1,000 shares of Apple, but the SEC says that I got those shares by insider trading, the SEC has the final say. I don't have those shares anymore, and the blockchain's wrong. So let's discuss when blockchains help. And this should be sort of like sad. Like, when I learned this, I was sad. Like, I hoped that this would help everything, right? I'm an engineer. I've had problems. It's great when all your problems go away with, like, one tool. This is sort of sad. So let's go on the positive side. When does the blockchain help? We sort of alluded to this. When the database is the final source of truth, right? It's a closed-loop system that's completely self-contained, like Bitcoin, right? Bitcoin only tracks ownership of this one little imaginary token, right? Database updates have to have high economic value because this proof of work process involves assumption of a considerable expense. And so you're probably not going to want to do this if the database updates in question aren't high value. So if cost is an issue, it's really if cost isn't an issue, blockchain might help. And the rules have to be simple and, once again, digital, because everyone in the world, every participant, has to validate every single thing. So if you have complex rules, it just gets out of hand very quickly. So money is one place where money is the problem that Bitcoin was invented to solve. Satoshi invented blockchains to create digital cash. Like, that's where they came from. It was not intended as a general purpose technology, and it hasn't succeeded as a general purpose technology. I don't know of any blockchains besides Bitcoin or something that is a very close copycat of Bitcoin that are successful at all. It's only the monies that are working. Moreover, money is a core, like a foundational civilizational technology. It is the economic good that coordinates all other economic goods. It's the basis for specialization and division of labor. Like, for example, take this laptop. You can't really see it. Or how about this water bottle? Something simple. Think of how many people went into the creation of this water bottle, right? Like, where'd the plastic come from? Where'd the cap come from? Who printed it? Who designed the printing? Where did the water come from? Thousands of people were involved in the creation of such a simple product. And why did they collaborate? These people didn't know each other. What coordinated this whole process? It was money. These were not barter transactions. Without money, something as simple as a water bottle doesn't happen. So money is very important. And I also think that it can improve quite a lot. The money we use isn't great. So I'm going to sort of skip this next slide because the previous speaker did a great job describing the properties of money. The thing to focus on is that money is not like some sort of shared delusion that happens as an accident. Monies that emerge for very specific reasons. They have properties. You can use rice or gold as money. People have used rice as money. People have used rice to pass down wealth to their heirs in lots of countries all over the world. Rice has a big problem. Not durable at all, right? So that's probably why gold emerged as money over time rather than rice. And this competition happened with every commodity, and gold sort of came out supreme. And gold worked pretty well until it didn't. So stock to flow is just this idea of, it's a way of measuring scarcity. We'll sort of skip that. The problems with gold was that it was not very divisible. You can't do like a $1 gold transaction. It's hard to transport, right? Like if you're driving down the highway, somebody knows there's gold in that truck, they're probably going to try to stop that truck and get that gold. It's hard to transport. And the two really, so those two sort of led to the creation of paper money. Paper money was the solution to these problems. They're like little receipts that represent your gold. This also happened because gold is hard to secure. Custody centralized, and people started using little receipts as money. And so what happened is over time, we ended up with paper money. And paper money is a disaster. So paper money is created by a political process. Cronies get it cheap. Donald Trump pays much lower interest rates than you do. He gets money for cheap because he has a position of power. Transactions can be blocked. You've probably read 1,000 articles about PayPal blocking transactions. They can, Visa the same way. Transactions only make it through if a number of intermediaries along the way let it go through. Moreover, it's easily seized. Your money in a bank is not really your money. You just hope to get it out. Like, it can be taken from you at any time. And most of all, the dollar has a 6% annual supply growth. So meaning, like, currently your dollar loses like 3 or 4% value every year. If it had a fixed supply, it would grow in value 3 or 4%, all things being equal. So this is a point of view that I was very skeptical of when I came into Bitcoin. I thought these were like crazy Ron Paul, Goldbug type people that thought this way. But some stuff like this made me change my mind. So there's this wonderful website, WTFhappened1971.com. It's a great URL, and the content is even better. So here's a graph starting from 1948 to 2017. Growth in productivity and compensation. So you'll notice up until about 1971, productivity and compensation grew in tandem. Starting in about 1971, productivity continued linearly, but compensation stagnated. 1971 was when dollars stopped being convertible to gold. That's when the money we use it went from having a sort of a peg to a physically scarce asset like gold to being arbitrarily printable in as large of quantities as we like. And this is sort of a shocking chart. Like maybe it's the case that corporations benefit more from this money printer than the workers do. That would certainly describe why productivity continues to go up, but compensation stagnated. Let's look at income gains based on the percentile of your income. So starting, before 1970, these they started diverging maybe slightly afterwards. 95th percentile, the high earners continued to earn. 20th percentile and the median stagnated. Maybe it's the case that these high earners benefit more from this political process of money creation than everyone else does. That they have access to cheaper credit and they're able to build wealth more than the rest of us. The consumer price index, this is measure of inflation. For most of the history of the country, it's pretty flat, right? You have war, print money, inflation goes up as the war, and then it comes down, same thing. This one is, I guess, the Reconstruction. And then here is when the Federal Reserve was created. This period here was the process where we went from using gold money here, and slowly we started using paper money that lost its convertibility to gold. And so you see in this period, we had the normal thing where you have a war and it comes down, and then the price level rises in World War II as you'd expect, but it doesn't come down for the first time. And then we leave the gold standard and it's vertical, just vertical. Like something is terribly wrong here. And lastly, national debt, right? This is how much our country owes. So you can see it's pretty flat for the decades prior to 1970. And once again, 1971 rolls around and it just starts going vertical. So maybe there is a relationship between the ease of bringing new dollars in creation and the ease of dollar-denominated, assuming dollar-denominated debt if you're a government. So I think these are all like very disconcerting, and they all sort of start happening around the same time. And so it begs the question, like this obviously isn't proof, but I want to just sort of implant this idea in your mind. Maybe this isn't crazy, that our money is a big problem. It's like a parasite that's gnawing at the fabric of our society. So my claim is that Bitcoin's a lot better than this government paper money. The big thing is that it's more scarce. The supply of, ask yourself this. If I want to store some value, there's two options. They're indistinguishable in every way except for one. Option A has no guarantees on the supply, and there's a couple people in a boardroom in New York that can print as much of it as they want. Option B has a very fixed supply that is encoded in an algorithm that has never been violated in 10 years and stops at a certain number, 21 million units. After that, there's no more. Which one of these would you rather store your value in? Which one of these are you more confident that your slice of the pie will be preserved? I think it's I think it's Bitcoin. It's just a much better guarantee that your value will be preserved over time. Moreover, it's a lot harder to censor. To censor Bitcoin, you have to basically monopolize this block production process. It's immensely expensive, and you have to continue forever. And it's hard to seize. You can split Bitcoins up into lots of little pieces. If you saw the talk by Unchained Capital or have ever met with one of these, that's what they specialize in, splitting Bitcoin up into multiple pieces, and you can stick these in multiple jurisdictions. So you'd have to have you have to go to different countries to constitute your Bitcoin and for someone to take them from you. This is much harder than gold or especially paper, where they can just take it from your bank. And I think it's better than gold too. I think I think it's a big improvement on gold in a couple ways. It's more scarce than gold. Gold is scarce, but there's not a physical limit on how much gold there is. There's a lot of gold in the universe, and there's a lot of gold in the Earth's crust. There are only ever 21 million Bitcoins. It's easier to secure once again, and it's much easier to validate, right? You get a gold coin. How do you know this is a real gold coin? It takes some degree of expertise. You have to do some chemical tests. You have to, go to an expert. You have to do all kinds of crap. With Bitcoin, you can download an app on your phone, and it'll tell you what the state of the blockchain is. And it got this trustlessly by downloading every piece of the history of Bitcoin. Lastly, it's native to the internet, and software is eating the world right now. And I'm sure you've all experienced this as young people. It's like your life sort of revolves around software. It's hard to imagine going back to a precious metal as money when an internet native alternative exists. Lastly, Bitcoin's better than the copycats, right? Bitcoin's code is open source, and so it's very easy to copy Bitcoin. And we've seen this. There's 3,000 copies or something. CoinMarketCap is a pretty exhaustive catalog of every one of them. And so they all, at the end of the day, they all compete as money, right? They're this purely digital thing that ends up competing as money. And in this competition, a new entrant needs to catch up to Bitcoin. It has this 10-year head start. Everyone's heard of it, right? It needs to get its name out there. And they do this by marketing. They raise money, and they just market. They take out ads, do stunts. And the problem is that this process centralizes control of this asset. And that makes it very different from Bitcoin. Bitcoin has no recognizable leader. The recognizable leader left 8 years ago, which is sort of remarkable. It's sort of a thing of its own. The developers who work on it are not affiliated. It's owned by countries that hate each other. It's owned by people that hate each other. No one controls it, and that's what you want in a censorship-resistant system. You do not want a group of people that can decide on the direction of the network. So in order to get this marketing, to catch up, to win this competition, it centralizes and it ends up having really bad properties as money. So it's kind of a catch-22. Like, I don't see how these things are ever going to win. Also, there's this idea that the crypto asset class as a whole is could serve as money. And I think that's insane because one asset can have a fixed supply. It can be scarce. But the class of all crypto assets is not scarce at all. If you have 1,000, make another. 1,001. It's inflationary as hell. So I think this idea is very flawed. Lastly, with every copycat that fails, I think this flippening, someone beating Bitcoin, becomes much harder. These things start competing with each other. There was 1, now there's 2, then there's 10, then there's 50, all fighting with each other. Meanwhile, Bitcoin starts competing with the Venezuelan bolivar. It starts competing with the lower level fiat paper currencies that are on their way out. And I think these two sort of diverge over time. And lastly, let's assume that we have a copycat that is better than Bitcoin. No, this hasn't happened yet, which should tell you something about the quality of effort that goes into these copycats. But let's assume one does happen. In the same way that people can copy Bitcoin, Bitcoin could copy the copycat. If it makes a true, deep technical innovation, Bitcoin takes the code, does it itself, and the copycat is not really a threat anymore. So I don't think the copycat blockchains that are competing as money have a chance against Bitcoin. So in summary, money is a big problem. It's important, and the money we use now is flawed. You can see it on practically every economic chart or every chart of our national economic activity. You can see when we went off the gold standard, like stuff happened, stuff went wrong around that time. And Bitcoin is an excellent solution to this problem. Blockchains, the application of Bitcoin's technology to other problems, the biggest problem is they don't interoperate with the real world at all. It has to be sort of a self-contained closed-loop system or it just doesn't work. You have the Oracle problem and you have enforcement problem. And so what is left if you can't do anything in the real world, if you're purely constrained to digital assets and you don't want money? You're left with this crap, CryptoKitties, like little digital collectibles. This is perhaps a valid application of blockchains. This may be the only one I can think of. And now, ask yourselves as you're going out in the world, college students, trying to make a difference, why build CryptoKitties when you can help fix money? This is probably not the way you want to spend your life. So that's it. Thanks. Okay, cool. Any questions? Okay.
So I'm in agreement that blockchains, at least the vast majority of it, should be used for money. But I was wondering about some more complicated usages of money that would fall outside Bitcoin's scripting system and would only be possible in Ethereum. My example is Augur, which is a decentralized betting market with a reward system, incentives, an adversarial system. And I was wondering if you had anything to say about that.
Yeah, that was when I first became interested in Ethereum 4 or 5 years ago. I was interested in it as an app development platform, not as an investment. I stupidly didn't realize you could make money by buying this, so I never bought any. That was sort of the way I approached it, and actually Augur and these were around at that time. And 5 years later, you look at the adoption. No one uses this. And if you'd ever talk to professional gamblers, professional bettors, people who hang out in Vegas and bet professionally, they don't care at all. So I don't know, it's...
I mean, is Bitcoin used that much for money right now? I mean, it's used a lot.
It's the top 20 currency in the world.
Money, I don't know. That's...
I mean, I'm not saying that, so this one does suffer from this Oracle problem. It's so the first thing I ever tried to build was a bookie. I tried to build a bookie on Ethereum. It would be able to you could place bets and it would pay out according to who gets it. And this is the Oracle problem. It's how do you know that the data that was fed in is good? It's tricky. I mean, it's possible. To me, it just doesn't. It seems like CryptoKitties. It seems like such a niche thing. Maybe it's possible. I'm not really even interested in the question. It's so niche. honestly.
Okay.
Maybe it's possible. Could be. Hopefully it is. Yeah, he's this guy. I'm going by the proximity to the mic guy.
So one thing that was interesting, actually, I guess kind of relates to some of our discussions before about value in the previous talk. If you look at one of the biggest roles that banking has right now, some of the best economists in the world have figured out that it's a credit creation system. And how do you picture, with kind of the ingrained entrance already in the blockchain market, with a large amount of the shares, how that credit creation process could be mimicked and you could create value? Because that's one of the main ways that, for example, businesses are created. They take loans out of smaller banks, and that's tied to productivity. That increases the value of currency.
It's a great question. I'm more of on the technical development side, so I don't know if I'm the best person to answer it. But when I talk to people who are more sophisticated with economics, they sort of have the opinion that a Bitcoin economy would have a lot less debt. And one of the reasons with it is just that the money is so much more scarce and precious. It's since it's more scarce, they're more hesitant to part with it. And it would be more of like a savings economy, right? Our current economy is largely based on credit. Like most people are in debt. The amount of debt people go in for college is massive. And a Bitcoin world would probably be more of a savings-based world, like it was before we moved to paper money. So I think it would change a lot, but I'm not an expert on this. No. Is that a Drew Brees shirt? No, that's a West Virginia. Is that? I haven't watched enough football recently.
Do you see any way that Bitcoin can be co-opted or corrupted the way that our money has? I mean, that's always something I worry about, and I like to think that the hackers are always ahead, a few steps ahead of the government, but sometimes they do catch up because, I mean, they've basically taken over Google and Facebook.
Yeah, I mean, that's the million-dollar question. I think there are some threats, like I think there are a lot of ways where the public confidence in the system could be shaken very deeply. Like if people think that they own Bitcoin, but they really only own a Bitcoin IOU, like at Coinbase, you don't actually own Bitcoin, you own an IOU. Coinbase owns the Bitcoin because that private key we saw earlier, Coinbase actually is in charge of that. You just have a login to their website. Like this is one of the tricky ways where if a lot of people own Bitcoin as a third party, with a third party, you could have a similar thing that happened with gold, right? Where over time these sort of you have paper money again on top of Bitcoin. Like I think that's sort of a pretty big threat. I think if governments had a huge concerted campaign to disrupt Bitcoin mining right now, I think it could probably be pretty big. But the beautiful thing about Bitcoin is that it sounds so crazy and silly that nobody takes it seriously when they should, right? And so I think having a large-scale disruption of mining by governments is unlikely, but it's possible. And I have some friends that also think that a large recession could be pretty disastrous, right? If everyone was forced to sell off assets to pay their bills, Bitcoin would be set back maybe 5-10 years or something. But I mean, these are some of the things that are discussed, but I don't know. They seem like we can address them. One more here?
Correct me if I'm wrong, but so we need the community to accept a technology to get it in practical use. So do you think with Libra Coin having 21 private companies coming in, like Uber and Facebook and all, do you think it could possibly be something that can be accepted as much as Bitcoin?
I think in the short term it would probably be accepted more because it's closer to what people use. It's more like Venmo than Bitcoin. It's largely like a new Venmo, new banking model. you don't have the hard guarantee of scarcity that Bitcoin has. And you also don't have the uncensorability. Those are the two important properties of Bitcoin. Libra doesn't even make an attempt at either one. So they're sort of very different things. And I think Libra's success in the short term is that, it's very possible, but it's more like you're really transacting dollars with Libra. You're not transacting, not really its own currency like Bitcoin is.
Thank you.
Thank you.